Good day, everybody. Well, welcome back after a couple of weeks. It's been quite a couple of weeks, to be honest. There's been a lot going on. We're going to try and pack as much as we can into this short period that we do have to update you where things are. And I think one of the things we really need to talk about is inflation, where it is, what it's doing, and where we go from here. But there is quite a strong consensus building at the moment that inflation may have peaked, particularly in the US, after last week's CPI data. And to be honest, it came off its highs, and core also dipped, which is what the Fed is more interested in, because core strips out the rather volatile food and energy components in that. But as you can see from the chart here on the screen, inflation is cooling somewhat. This is relatively positive news, I suppose, and stocks continued to squeeze higher over the last week, driven by some fairly mechanical purchases. But this idea that maybe the Fed won't have to be so aggressive going forwards. Traders have reduced some of the pricing from 75 basis points in September of hikes down to about 50. And the hope is that the worst news may be behind us. And as you can see here, tech stocks have reflected that by leading quite a severe and serious charge higher until we've seen some weakness actually today. So on this front, we can see that the idea that inflation is beginning to turn over has been a positive for risk and equity markets up until today. The reason why there's some doubt today is we do have a Fed FOMC minutes coming out a little later. However, as ever, there's a bit of a caveat to some of this, and there is a big difference that I need to get across to you between inflation peaking at around 9% and returning anywhere near to where the Fed's inflation target is at 2%. Now, what we don't know is how many more hikes that will take, whether they want to front load these, and what that may do to stocks from here. We must bear in mind as we go forward that the Fed is pretty determined to tighten financial conditions, which probably needs stock markets going down, not going up. So how aggressive will they be? So I think, we're at a bit of a crossroads. Yes, it's encouraging to see a peak in inflation, but we are not out the woods at the moment because the central bank may have more to do to really get this genie back in the bottle, if you like. And I think, we are suggesting that there is still more to be done. However, if we move away from the US and start focusing on some of the other major economies, it's quite clear that inflation is still a major problem in places like the UK and, in fact, the EU. And the UK this morning had some pretty dire inflation data, moving into double digits now, up from 9.4% in June. But to be honest, this is kind of what the Bank of England has actually suggested and forecast that we may be facing. Pretty grim outlook, to be honest, talking about potentially 13.5% inflation in October, at the same time that we're going to get reduced or weakening growth. This is not a good cocktail of things for a central bank to have to deal with. We're also seeing, because of inflation, wages are rising, but they're not rising high enough to keep up with inflation. And so real earnings are actually falling quite hard, which is just another thing that is impacting or weighing heavily on the UK consumer at the moment, let alone the rising energy costs that are still to come into the autumn. So as you can see, the Bank of England is on the chart on the bottom here, battling criticism that it's lost control over inflation. And to be honest, it has. It was late to this. And to be honest, they've been a bit disappointing. Are they going to catch up? The question here now is how far are they prepared to go if UK growth really starts splintering and heading lower at pace? So we've got about 50 basis points priced in for the next Bank of England meeting in September after the data we saw today. Not surprising. We saw massive moves in UK bond markets. They fell very heavily, particularly short sterling, falling 38 basis points, which is a big move. But people say, well, surely that should have supported sterling. Well, not, because realistically, this is not good for the UK economy. It's not good for sterling. It's not good for the consumer. And it's not good for global investors looking possibly at the UK as somewhere to invest. I mean, things look pretty gloomy here. And high inflation and weak growth is not a place you invest in. So I'm afraid that the UK looks a bit dangerous here. If we break this sort of 120.04 120.05 level again. As you can see here on the chart on the right, this is an hourly chart, but even this shows up on the daily chart as well. If we break those sort of lows just around 120, the technical outlook is going to join the fundamentals, and that's going to give us a pretty powerful signal that we could be sort of heading lower. But at the moment, we're holding. We may need the dollar sort of to play a bolder role to get the cable down. But sterling against some of the other crosses has also been slightly weak. But there is a general feeling that maybe the dollar's on the turn here as well. So I think this is really interesting setup for sterling at the moment, but the fundamentals really do not look that great at the moment. And I do worry about what kind of winter we're going to head into when it does finally arrive. The EU do have similar problems. And again, the problem here is that we have a situation where EU inflation is probably going to drive the ECB to do more. We have seen what we call 2-year break-evens. This is the inflation expectations are becoming unmoored. Now, you'll always hear Lagarde and her compatriots at the ECB talking about inflation expectations are still anchored. It's looking like they may not be. Now, investor confidence in Germany is falling pretty rapidly. At the same time, they have high inflation. If Germany's getting battered pretty hard, but this is the same issue across Europe. We saw the German ZEW data showing this falling confidence, as you can see on the chart here, and EU households are facing pretty unprecedented rising costs as they go forward as well. So again, things not looking good there. Some of the alternatives against the dollar are not looking particularly strong, so maybe the dollar may start attracting back again. But at the moment, the euro is actually holding up pretty well against the dollar, which I'm slightly surprised at. But I think this is because these inflation break-evens are breaking away, and the ECB is looking like they're going to have to go 50 basis points at the next meeting. But this news is likely to cause major problems for the ECB because, again, they are nervous about hiking aggressively when economies, particularly in Germany, are actually looking so weak. So could they be more aggressive on hikes? They should be. Will they be is another question. So we need to be careful here. The euro is in a bit of a downtrend still. The rally was more of a dollar weakness move, I think, rather than a euro strength. But then we got that extra boost as we saw inflation break-evens breaking higher. And I think the market is now beginning to price a slightly more aggressive ECB into the next meeting. But what damage will that do? Again, I think we need to be careful exactly what we hear from Lagarde next time we hear her speak. But at the moment, the German 40 has been dragged up solely by what's been going on with US stocks. I think there is some inherent weakness in the German 40 because the companies are now beginning to struggle. The rising costs for German companies to stay open with energy costs is absolutely huge. That has to mean that probably we're going to start seeing layoffs or factory shutdowns. I mean, the economy doesn't look great. And I'm not sure that this rally on the German 40 is totally justified at the moment. And I think it has a lot to do with following the US. But there are risks out there is the only way I'll put it. And I think at the moment there is some vulnerability in some of these equity markets because the fundamentals are really not looking particularly strong, particularly outside of the US. And we need to sort of keep a gauge on what central banks are going to do from here. So, the central banks are focused on inflation. The market seem to be beginning to think that the central banks can engineer fairly soft landings. I think that is highly questionable as we go into winter, personally. So that's kind of where we are with this. I think it's going to be an interesting couple of weeks. As I say, we've got Fed minutes tonight. We've got Jackson Hole gathering 25th, 27th with all the big central bankers there. That's going to be a big event that we need to keep an eye on.